Earnings season can have an unpredictable effect on the stocks in your portfolio. It's certainly something that every individual investor should know how to handle when it comes around. So let's talk about how to manage a stock around earnings and how you can still take advantage of buying opportunities even when earnings are getting in the way. Earnings season is a time when true leaders will reveal themselves and lagging companies will take a back seat. Earnings reports can be the catalyst for many of the largest moves in stocks, and it's no secret that they require special care. A strong report can fuel stocks to new highs and trigger new buying opportunities. But on the flip side, companies that miss expectations may see their shares take a serious tumble. So, as you may already know, companies disclose their earnings 4 times a year, and they typically occur all within a span of a few weeks. These quarterly reports give investors the opportunity to review the inner workings of the companies that they've invested in or are considering and reassess the potential of the stock going forward. Additionally, analysts and professional fund managers use an earnings report to project the company's future earnings and sales growth and create price targets for the stock. But it's the market's reaction that'll tell you more about the earnings than even the reports themselves. The stock's reaction truly puts the results in proper context. If the results seem strong with beats on both the top and bottom line, a sliding stock reaction may signal that investors are more concerned about things like sustainability of growth, rising costs, lower guidance, or a myriad of other possible negatives. Conversely, a weaker than expected report with a positive stock reaction can signal underlying strength in the company's future. A key thing to pay attention to when a stock has earnings is the breakaway gap. The breakaway gap can send a stock catapulting out of a proper base. They occur when buying demand surpasses the available supply of shares to be sold so much that the stock has to rise high enough in price to convince holders to sell their shares and match the heavy demand. If a stock gaps up powerfully and trades more than 5% above the proper buy point, you want to wait for the first 5-minute bar to appear using an intraday chart, and you want that bar to look strong. Then you want to buy shares as close as possible to that bar's high price as the stock moves past that level. Now, this is if you're going to be really aggressive in this stock. You can also wait to see how the stock trades in the first hour of the day in case it pulls back, or even later in the session to make sure that it's holding up. You just want to make sure that you're not buying even more extended than necessary. And remember, just like with any purchase, you want to be sure all of the elements are in place. For example, we want the stock's fundamentals to show that it's a true market leader with strong earnings and sales growth in recent quarters. Also, it should be high ranking in its industry group, and the market should be in a new confirmed uptrend. Let's look at an example from 2018. Medifast stock broke out of an 11-week consolidation with a 74.78 buy point. The base features a strong surge in volume as shares approached the buy point, as well as a strong uptrend prior to the base's formation. On the breakout day, March 7th of 2018, Medifast soared over 30%, surging above the entry. We can see that shares opened above the 74.78 buy point and even past the 5% buy range of that entry, which went to 78.62. Volume skyrocketed more than 1,100% above average, indicating excellent institutional demand. Even though the stock totally missed its 5% buy zone, it still may not have been too late to start a position. Investors could have used the high of the first 5-minute bar of the March 7th breakout day as an entry point. From its March 7th closing price of $92.91, shares had a powerful multi-month rally featuring several more breakaway gaps before topping out at a high of $260.98 in September of that year. That's a roughly 180% gain from the March 7th closing price. The catalyst in the 2018 move for Medifast was a much better than expected earnings and sales report. Medifast, a provider of weight loss programs, reported quarterly earnings and sales increases of 76% and 25% respectively versus the year-ago period. Earnings growth accelerated for a second straight quarter from 0% to 8% to 76%. Meanwhile, sales also accelerated from 6% to 13% to 25%. Accelerating earnings and sales growth are other key bullish metrics that can help spark powerful price moves. Another important aspect to this is knowing how to handle a pre-existing position around an upcoming earnings report. This often comes down to how much of a profit cushion you've built in a given stock and how big of a gap down you could withstand following a negative report. We recommend you have a profit cushion of at least 5% in most cases, but this can depend on the expected move of a stock. You may treat a slow and sleepy stock differently than a high-octane stock because their reactions could be very different. A good option to consider ahead of an earnings report in a stock that you own is taking some money off the table. The IBD way of managing positions is to always scale in and scale out gradually if possible. So if earnings are around the corner and you have a stock that's up 20% from your original buy point, it makes sense to consider taking off a third or two-thirds ahead of earnings to lock in some of your gains. Even if your gains are smaller, say 10% or 15%, this may be a valid option in case of a big unexpected gap down in the stock. How much you take off the table ahead of earnings depends on your conviction in the stock. If you're in a stock that you feel is going to become one of your big winners to hold over the long run, then you won't want to get rid of it completely before the earnings announcement. And this assumes you have a profit on the stock. But it's also smart to be discerning. Don't treat every stock like it's going to be a definite home run. Scaling back a position substantially ahead of earnings is just good risk management and an important avenue for investors to consider. Above all, the most important tip for handling stocks around earnings is to try and act swiftly. Stock moves following earnings can happen rapidly, so you want to try and react quickly to protect your portfolio. You don't need to have a knee-jerk reaction right at the open. Make sure to consult intraday charts and use them to your advantage. If you're on the wrong side of a big sell-off in a stock, thinking you can just wait it out and hope it gets better, that may not work in your favor. Even if you're holding a stock following a big gap down and you still have a decent profit cushion in that stock, it's a good time to highly consider closing out your position on the stock. A huge gap down, especially one that puts the stock below key moving averages such as the 50-day or 200-day line, can signal a real change in overall sentiment towards that stock. The earnings report may have supplied some new key information that's truly changed the future potential of a stock, and no matter how attached you've become to a given stock, you must always be able to let it go when new information arises.